Thank you, Margaret, and good morning, everyone. Welcome, Director Calabria.
Oh, thank you. It's great to be here.
So Fannie Mae and Freddie Mac, your agency has been regulating them since they were brought under federal control after the financial crisis in '08. And the Treasury Department last month released a plan to hopefully get them back standing on their own 2 feet. There are experts, though, and many in the American public who go, well, you know, things have been kind of going okay. Things have been fine. They aren't engaging in the pernicious activity that they were, that led up to the crisis. So what's the rush? Why not stick with the status quo?
So let's kind of peel back the onion a little bit. Let me first say, I think if I could just paraphrase President Kennedy and say, the time to fix the roof is when the sun is shining. We do have a good housing market today. We have a pretty strong economy. So to me, if you're going to make these fixes, it's easier and probably better to do it now than to wait till we hear a crisis. I am somebody who believes we haven't repealed the business cycle. We haven't repealed the housing cycle. I'm not certainly forecasting any sort of downturn, but I think the reality is you and I will live to see a downturn in the housing market. Fannie and Freddie today are approximately leveraged 500 to 1. No financial institution at that level of leverage will survive a downturn in the housing market or the economy. They will fail. So for me, the first objective as a safety and soundness regulator is to get them to be safe and sound. That's kind of like, you know, in the job description.
You say you're not predicting a downturn, but I did listen to a talk that you gave at AEI, I guess was a week or two ago, and it was a little bit scary, I have to say. You said you saw warning signs, a lot of things that we saw before the housing crisis in '08. You said cultural issues haven't been fixed. What are you seeing? What hasn't been fixed, and how concerned should we all be that another crisis might be looming?
Well, I think we should always be concerned that housing markets go up and go down. And so, you know, when my friends ask me whether they should buy a home, my first question is, well, how long do you plan to be there? You know, because again, the amount of time you may be there is how much you might gain appreciation. And again, the cycle turns pretty quickly sometimes, and so you can actually see pretty big drops. So I do think that when we get people into homeownership, we should do so with a thought of, is this sustainable throughout the cycle? Or is this really just, okay, you're going to ride it on the way up, cash it in and get out? That's not, to me, sustainable homeownership. Sustainable homeownership is getting somebody in where they can stay in. And again, I would, on a bigger level, say my philosophy as a regulator is to hope for the best, but to plan for the worst. And if the worst doesn't happen, that's great. But if the worst does happen, I think it's important for us to be prepared. And we are seeing a lot of the same practices. I mean, for instance, Fannie and Freddie's footprint in investor homes is as big today as it was before the crisis. And we all remember, you know, those of us who've seen The Big Short or remember the stories of the person.
Or lived it. I mean, you were at the banking committee. I was covering it at the Bush White House. We were in the thick of things.
And, you know, I will say, I remember 2006, 2007 being pretty regularly told at events like this that prices never go down and, you know, there's nothing to see here and Fannie and Freddie are very safe. So for me, a lot of it starts to sound a little deja vu. Right. So maybe I'm a little, you know, once burned, twice shy, if you will. But again, we have these things happen. I'll say one of the things that I know that made me popular on the banking committee staff is I always gave our new staffers a thick list of savings and loan crisis material to read and would say, this stuff happens, we need to be prepared for this.
When you talk about, though, that now is the time to fix the roof when the sun is shining, I hear implicit in that a belief that there will be some level of disruption when you fix this roof, such that it can only be done in fair weather, a strong housing market like we have. So how disruptive will this be?
So I hope what it ends up doing is minimizing disruption. So the first and most important thing we do is build capital. So I think it's fair to say that if we're in a down housing market or a down stock market, not a lot of people are going to be interested in buying equity in Fannie and Freddie.
Right. So and you've started with that. So $45 billion is what you said you can go up to.
So delighted to say in the 6 months I've been there, we've doubled the capital at Fannie and Freddie. They're no longer 1,000 to 1, they're just 500 to 1. Right.
So it's not enough. What do you
Far
have to
from
hit?
it.
What do you have to hit?
You know, Fannie and Freddie are, you know, they're multi-trillion-dollar institutions. Freddie is about the size of Citibank, for instance. They represent a core part of the financial institution. These entities are the core of our mortgage market. They're simply too important for us to gamble with and not regulate them in a way that's safe and sound. So to me, the other institutions that are similarly systemically important need to be regulated in the same way. So to me, Fannie and Freddie are just too important for us not to regulate them appropriately.
What I was interested in hearing more about was what you discussed Tuesday at a hearing, testified on the Hill. And some of the lawmakers there were just a little concerned about the profit that would occur, with the retention of the earnings that you're allowing, that it would end up hugely benefiting hedge funds. And you said at the time, you said, quote, I very much am on the record over the years as saying, in 2008, what we should have done is wipe out the shareholders. If the circumstances present itself where we have to wipe out the shareholders, we will. So under what circumstances would that happen, and how would you accomplish that?
It's spelled out in statute, so it's generally if they become insolvent. You know, one of my frustrations with the 2008 crisis was we had a number of mechanisms, whatever the institution, whether it was AIG or GM or Fannie Mae, where this is what you're supposed to do when an institution is insolvent. And there was an attitude that was very bipartisan that said, you know, let's find ways to go around the normal processes to resolve failing institutions. And to me, some of those were extra legal, and of course, that's why a number of institutions have had 10 plus years of litigation. Fannie and Freddie aren't the only ones who've been litigated for 10 years over these issues. So there was a mechanism in law that would have very cleanly wiped out the shareholders. You wouldn't have 10 years of litigation, would have rehabilitated these companies and put them out in the marketplace. Perhaps I have a great comfort in that because I helped write it. But it's a pretty solid, it's a model we know that works. In fact, it's Title II of Dodd-Frank. This is what Dodd-Frank says it's going to do to Citi and Wells and all of these institutions. So again, we have a framework. The FDIC's done it for decades. It's the law. I believe we should stick with the law.
Fair housing advocates are not only concerned about the issue I just mentioned that many in the committee were, but they're also worried about the too much freedom for Fannie Mae and Freddie Mac could start to lead to higher mortgage costs and then increasing difficulty in getting mortgages, in particular for lower income Americans. So can you guarantee us right now that at the end of this process that mortgages will not be higher, that mortgages will not be more difficult to achieve?
Would you like that guarantee to be implicit or explicit?
Let's explicit it in writing, maybe.
So let me say, first of all, my primary responsibility is for the safety and soundness of Fannie and Freddie. And what I'm sure of is if Fannie and Freddie fail, that access to credit will be reduced because of that. So for instance, Fannie and Freddie were the largest participants in low-income housing tax credit market before the crisis. When they were about 60% of that participation before the crisis. When they failed, they exited that market. That stopped a lot of affordable housing production because they pulled out. So to me, the most important thing we can do to make sure that Fannie and Freddie are there to support the affordable housing is to make sure that they're safe. It's just like when you get on the airplane when they tell you, in the case of emergency, put your own oxygen mask on first. This is what we're trying to do. And again, my concern is I often hear suggestions of, yeah, I know the foundation to the house is really cracked, but let's go ahead and put that second, third floor on anyhow. We need to fix the foundation. And that will make everything else stronger.
So no guarantee.
I am an economist and I know better than to try to forecast the future. I feel a high degree of certainty. I said it in my confirmation hearing. I'm absolutely certain that the 30-year fixed rate mortgage will be widely available and affordable by historical standards when I leave. I have no doubt that that will be the case.
No doubt. So how will the government protect that 30-year mortgage? Because it's interesting when you look at the plan. There are two contradictory items in there. It says the 30-year mortgage would be protected, but then it also says long-term mortgages would possibly remain available without government support.
Well, there are a lot of government mortgages today without support. If you're in the jumbo market, which most of Washington, D.C. is, there's no guarantee on that mortgage necessarily. They're widely available. In fact, they often are cheaper than GSE mortgages. So again, we have a mortgage market. Much of the rest of the world provides a mortgage market. But again, what I'm trying to do, and I guess I should certainly emphasize the administration's plan is the administration's. Right. I'm an independent regulator. What I'm trying to do is fix Fannie and Freddie so they can perform the role that they've always performed. And again, it's so critical to keep in mind the importance of Fannie and Freddie and the Federal Home Loan Banks that I regulate is to be there in times of stress. And they can't be if they themselves are broken.
But again, how do you protect that 30-year mortgage?
I think we'll be able to do that by fixing Fannie and Freddie to provide the credit there. So if we build more capital, that creates more confidence in Fannie and Freddie. That allows them to operate throughout the cycle. We really did. You go back to 2009, you go back to 10, you go back to 2011. Fannie and Freddie pulled back. They focused on protecting themselves because they were insolvent and failing. And if we can help them, and we see this across financial institutions, whether it's banks, insurance companies, GSEs, the ones that are well capitalized and well regulated, when they go into a crisis, they continue to support the market. The ones that are on the brink of failure pull back.
Have you seen any signs that the private market is ready to provide alternatives? Because when you look at the idea theoretically of competition, of creating these other entities, I mean, right now, first of all, that would take an act of Congress to issue a new charter. I know you're asking for that ability to do that yourself, but even so, then a new competitor would have to raise tens of billions of dollars, would have to establish a reputation on the national stage, the equivalent of Fannie and Freddie, and then have a attractive rate of return. I mean, is that not going to take years?
Well, we're not going to find it if we don't offer it, right?
Okay.
So, until we can get to that point, I really will emphasize, the economics I learned. I have a PhD in economics, whatever that's worth. And the economics I learned is that if you want to bring prices and choices and innovation, it's really got to be competition. And if I could use an analogy, when I was in grad school, a lot of what we talked about was the breakup of AT&T, Ma Bell. And if you remember, Bell Laboratories at that time was the most innovative place in the world. And all you heard was, well, if we broke up AT&T, where would all that innovation go? I feel quite confident in saying if we didn't break up AT&T, all those great phones you have in your pockets would not be like they are today. I think we've been more innovative on telecom since the breakup of AT&T in bringing competition. And you see that today. I mean, Fannie and Freddie dominate the landscape, and they stifle innovation that would come from others. And so, again, I think a competitive landscape will be better for consumers.
And you see signs that the private market
I do
is ready?
see signs of that. And again, like I said, if you look on the margin on the high dollar loans where the mortgage market, the jumbo, you can get a jumbo mortgage. You've got securitizations today that are privately done that have GSE eligible mortgages that go on private securitizations. But one of the things we're trying to fix, I've been working with CFPB to fix the so-called qualified mortgage rule. That's one aspect. You have a number of rules where Fannie and Freddie are exempt from them. So my view is I want Fannie and Freddie to be successful, but I want them to be successful because they have good management, they have good execution, they have a good business model, they're regulated well. I don't want them to be successful because they don't have to play by the same rules as everybody else.
How important is it that you work with Congress on this? Right now, you're proceeding to do what you can on your own. And in the hearing on Tuesday, you said you wanted to work with Congress. So
Absolutely.
how do you think that is that going to move forward? What's standing in the way? And if you don't end up getting action in concert with them, what are the risks of continuing to proceed on your own as you are?
Well, let me preface, nothing I'm doing is anything other than what I've been directed to do by Congress. So often, there became this myth, because it is a myth, nothing in the statute says you don't release from conservatorship unless Congress approves. I've never heard of the FDIC asking Congress for permission to release a bank from conservatorship. I was on the Hill when we created this. There were debates about congressional triggers. Those were rejected. The statute says I have two choices. I rehabilitate them, fix them, get them out, or I take them in the receivership. Endless limbo is not in the statute. Permission from Congress to release them is not in the statute. So I do want to be clear. I'm not going to wait around whatever the issue is for Congress to tell me to do what Congress has told me to do.
Before we go to the audience, I'd like to talk a little bit about affordable housing. And the Treasury plan has a couple of items that mention that. It says it recommends your agency take administrative action to come up with, quote, more efficient mechanisms for Fannie Mae and Freddie Mac to achieve the required affordable housing goals. And then it also calls on Congress, again, needing congressional action, to pass new laws to replace those goals, quote, with a more efficient, transparent, and accountable mechanism for delivering tailored support, close quotes, to lower income rural and then first-time home buyers. I mean, you have said you want the government to play a limited role in the housing finance sector. It sounds like this Treasury plan is designed to do just that.
I think the Treasury plan on the affordable housing goals, and let me also say, it's important to have government partnership across the spectrum. So, I've often talked about my 3 L's of land, labor, loans. I have the thing I have oversight of the loans, but if we don't fix, for instance, land use policy in this country, you can throw all the money you want at it. If you can't find a carpenter to build it, and you can't get the permit, and you can't get the zoning, it doesn't matter.
So you're saying a lot of this is on the local level?
Absolutely. We all have to work together. This is simply not the responsibility of federal government. It's the responsibility of county government, state government. It's everybody's responsibility to work together because so many of the obstacles are there. pivot back to the question on affordable housing. Interestingly enough, historically the way it's been set up with Fannie and Freddie is their housing goals are income-based, but the way that they have developed products have been predominantly on credit-based. And so, yes, of course, borrower credit and income are positively correlated, as we economists would say, but they're not perfectly correlated. And so what you actually have today is you may have higher credit, low-income borrowers subsidizing higher income, poorer credit borrowers. And again, the goals are based on income. And so trying to have a more perfect fit between income and the actual goals, I think, is important.
And that won't end up excluding too many lower income Americans.
That will not. In
African
fact, it
Americans.
will make sure that the subsidies that are provided, the support that's provided, and of course, this is to support the entire market, of course, but it's also to make sure that the carrying out of the goals is more consistently aligned with the statutory requirements.
All right, let's go to our audience for questions, and we should have mic runners, so if you would raise your hand and stand up and identify yourself. Okay, well, maybe you guys, okay, we have a question right here, gentleman in the glasses.
Going to apologize with the lighting. I
Yes,
can't
sorry.
always see who you.
Hi, Mark.
Okay,
It's
Paul.
Paul Leonard with the Housing Policy Council. In trying to create more of a level playing field to lay the groundwork for possible reform, how much progress do you think you can make on access to the GSE's data, more transparency on data sharing, licensing, whatever you think would be possible? Thanks.
I think there's a lot that can be done here, just like some of the big tech firms sort of have an entrenched market position because of the data they control. Fannie and Freddie have a very entrenched market system because of the data they control. I've actually hired an advisor who's my senior advisor, Lynn Fisher, who does my economics and statistics. And one of the things I've tasked Lynn with is how do we make sure that the data that we can have and share that's protective of borrower privacy. We will do nothing that ever jeopardizes borrower privacy. But how do we make sure we get more of that data out in the marketplace so that more informed decisions can be made by all market participants about the risks and characteristics in the market?
Okay, another question? Gentleman here.
Hi, Sam Gilboard, National Apartment Association. Saw it in the Treasury plan, but can you talk about how the GSEs will consider mortgage acquisitions for properties in rent-controlled jurisdictions?
Good question.
So, maybe after I fix everything in Washington, I'll think about going to Albany or Sacramento and fixing everything. We do not, it's not my objective, not my intent, not my responsibility to fix things at local level. I will try to be a bully pulpit when I think we can move things in the right direction. We are going to take whatever the state and local policies that happen into account from an empirical standpoint. And so where I'm going with this is, so if something is done at the local level that affects, for instance, the value of a property, because perhaps it affects the discounted future cash flows of that property, then that affects the underwriting. But this is across the board. Anything that impacts the underwriting that affects the property value is going to affect what you underwrite it at. And that's how it all enters. And it's an empirical question. For instance, a number of studies have found that rent control actually ends up that less people enter the market. Well, if that means less people enter the market and rents go up, property values could go up. They could go down. We're going to let the data drive that.
All right, more questions? Okay, thank you.
Thomas D. with Capstone. In addition to the GSE's regulatory capital rule, which you're working on right now, the GSEs have statutory capital requirements.
Correct.
I was wondering if you could talk about the significance of those rules as it relates to the decision to end conservatorship.
Well, I will say that since we are in the middle of a rulemaking on the capital rule, I can't go into details. I will say I hope to be able to say within the next 2 to 3 weeks whether we will repropose the rule or not. It's quite a complicated rule, and in fact, I would say...
Could you explain it?
Sure. So to go back to my earlier point about the 500-to-1 leverage, that equity cushion that any company has is really that protection between insolvency or not, failure or not, protecting creditors, protecting taxpayers. And so to me, and I think this is true for some of our largest financial institutions, it was certainly true for Fannie and Freddie, that lack of capital is really what triggered their failure. So making sure that Fannie and Freddie have appropriate capital. Now the risk-based capital standards, you often have these leverage standards, which is here's your assets, here's your capital you hold. The risk-based capital standards are often done on a sort of bucketed basis of, this is this asset, it's this risky, you hold this much capital versus this. And so a lot of that drives the choices and decision making at any financial institution on what kind of activities they will engage in. And I want to make sure we have a level playing field. One of the reasons that Fannie and Freddie were able to dominate the market is because they were required to hold so much less capital against everybody else. So from a very level playing field, equality under the law, equal treatment, if you will, I believe anybody who has a federal charter who holds a mortgage should basically hold the same capital as anybody else who holds that mortgage. And so that, if you will, the industrial organization of mortgage finance is not simply driven by who gets to be the most highly leveraged.
All right, well, Director Calabria, thank you so much for joining us and for
Absolute pleasure.
clarifying what is a very complicated issue. Thank you.
Thank you.